All right, folks, we are now at week 10. And so this is our last chapter we're going to cover. Capital budgeting, also known as budgeting for capital expenditures. What's unique about this is these are fairly large amounts of outflows of cash. Therefore, additional analysis needs to be done by management to make sure that the outflows of cash for whatever they're investing in is going to be the most economical possible. So we'll talk about some techniques in capital budgeting. Why is this important? Well, it's important to have the right information and do the right analysis because these capital investments are long-term in nature. So because of the long-term nature of these things, these outflows, the outcome is uncertain. The further out, the more uncertainty. These investments involve a long-term commitment. It's really difficult to undo a decision. For instance, when I worked for Valero Energy, we were a much smaller company back when I was there, fairly new company. But we bought an interest, 50% or 51% interest in a refinery called Sabre Refining. And it was our first endeavor into refining. And this Sabre Refinery down in Corpus Christi, Texas, needed quite a few upgrades. And so the issue was whether or not to invest $500 million in upgrades to get this refinery to where they wanted it to be. Their initial investment of the 51%, by the way, was about $1 billion. So not only had they put $1 billion into this already, but they were about to put $500 million into this. This was back in the early 80s. So, I mean, this is 35 years ago. Think of 500 million in terms of present value today. I would think it would be closer to $1 billion or maybe even more. But anyway, for a small company, I mean, we're still Fortune 500 company back then, but we were a small Fortune 500 company, if that makes any sense. And so the decision was made to do the upgrades. This was a 50-year decision because the payout on this was going to be over an extended period of time. So once it was decided to do it, barring bankruptcy or buyout by another company, this decision could not be changed once it's made. And so large amounts of money are involved. Decisions are difficult or impossible to reverse. They all kind of fit together. And so if you have alternate options, you want to pick the option that's the most profitable. And recall that pretty much every time, unless you're just a company that has limitless amounts of capital to spend, which I don't know if there really are very many anymore, but let's assume you only have a limited amount of capital to spend. You want to spend it on projects that are the most profitable options. So examples of capital expenditures are plant expansion. New equipment could be one if it's fairly substantial, and possibly office renovations if it's substantial and done over, well, it's a substantial outlay, and the benefit's going to be over several years. And so you have to consider financial as well as non-financial considerations. Some examples they have here: pollution control system, whether or not to invest in new pollution control system. Well, if you need one, you need one, right? But you know, some non-financial considerations, even if it's a close call, might be the environmental concerns and what the public image of the company would be if, you know, something bad were to happen if they didn't choose to invest in the pollution control system. New factory lighting, better working conditions, better product quality. Employee health club might increase the morale of your employees, their energy level. You might have healthier employees, thus resulting in maybe lower medical expenses incurred by the company, as well as the employees. Less time off by employees, things like that. Employee child care facility, you know, how does that look? Certainly that's going to help with employee morale. It accommodates working parents, especially working mothers, but any kind of parents really, and would enhance scheduling flexibility as well. So, I mean, you have to consider financial as well as non-financial matters anytime you make a capital expenditure. And so when you make these capital investments, you're going to have both cash outflows and cash inflows. Some typical cash outflows are repairs and maintenance. You're going to have to make repairs even to new capital expenditures. Over time, you're going to have to maintain the capital expenditure as well. Your initial investment, obviously, and any incremental operating costs as a result of this capital expenditure. Some typical cash inflows would be any cost savings received from doing the capital expenditure, incremental revenues received from doing the capital expenditure, and any salvage value that might be had. All right, so we're going to talk about, I don't know, 3 or 4 different types of methods that you use in determining whether or not a capital expenditure should be done or not. And so some of them are quick and dirty, as I would call it. Something you might do if you're a mid-level manager. The capital expenditure is not exceedingly expensive, but still needs some analysis. If they're going to purchase a new machine, for instance, and that new machine was going to cost, I don't know, $50,000. Certainly that's a capital expenditure because it's something that's going to benefit the company over a period of time, but it's not necessarily a major capital expenditure, so maybe less sophisticated analysis can be done. And so some of these methods are quick and dirty for those types of decisions, whereas some of these methods are more sophisticated and worthy of the larger outputs of capital, such as a plant expansion or something like that. All right, and these methods revolve around at least a couple of different examples. And so our first example involves this fact scenario. We've got this stadium that's considering purchasing vending machines with a 5-year life. The cost of those vending machines are $75,000 total for the however many machines we're talking about. The revenue from these machines is predicted to be $84,375, and the cost of selling those items is $50,625. So they're expecting gross profit out of these vending machines of $33,750. On top of that, they're going to have cash operating costs of $3,350 and depreciation of $14,000. And so their pre-tax income is going to be $16,400. And then they figure income tax is going to be $6,400 off of that pre-tax income. So after-tax income is a nice round $10,000. Now, note depreciation is a non-cash item. It's not a cash outflow. And how did they determine the depreciation for a year? Well, it's the same way you do straight line method. You should have learned that in financial accounting. They took the cost, $75,000. They deducted the estimated salvage value of $5,000 and divided that into 5 years to get the $14,000 annual depreciation. So this is an annual analysis. Although the cost of the machines in year one is $75,000. And so most capital budgeting techniques use an annual net cash flow. And again, recall that depreciation is not a cash outflow. So what you have to do anytime you see this to figure out your annual net cash flow is to net income, you're going to add back in your annual depreciation to come up with your annual net cash flow. In this case, their annual net income was $10,000, and so they're adding back in the annual depreciation of $14,000 to get their annual net cash flow. This is kind of like, well, a very simplified version of the indirect method in determining your operating cash flow when preparing a statement of cash flows, if you did that in financial accounting. You add back into net income your annual depreciation because it's not a cash outflow. All right, so the first method we're going to look at is called payback period. And the payback period is the time expected to recover the initial investment amount. And so in our example, the initial investment amount was $75,000. And so payback period is, as your numerator, the amount to be invested in our example, $75,000, and you're going to divide that into the estimated annual net cash flow of $24,000, and so that's going to be somewhere in the range of a little over 3 years, just eyeballing it. And so the payback period is exactly 3.125 years. Now, if you have alternative projects you're looking at, you might be tempted. And so, first of all, what does payback period say? What is the 3.125 years? Well, it's the time it's going to take to recover from net annual cash flows your initial investment, your initial outlay of $75,000. So if you have, now back to what I was saying, if you have alternative capital projects you're looking at, you might be tempted to pick the payback period, well, the project with the shorter payback period, right? And as a general rule, that may be true, but it might be short-sighted. And so, first thing, some of the problems with payback period. First of all, it ignores the time value of money. Hopefully you've learned something about time value of money up till now. If not, when you get to finance, you will, hopefully. It also, and this is my point, it also ignores the cash flows after the payback period. And so here's an example of that. We have two projects, and each has a 5-year life and costs $6,000. Project 1 gives you net cash flows of $2,000, pretty even over time, right? $2,000 every year for those 5 years. And Project 2, net cash inflows, only $1,000 the first 4 years, and then look at 5, bam, $1 million. So if you used the general rule that you pick the project with the shorter payback period, you would pick Project 1, but that's not necessarily the right answer because look at the payback period if you're patient in Project 2. Return on investment if you look at other books, they call this, or return on average investment, same difference. Many books call this the average rate of return. So if you see that phrase, average rate of return, or ARR, just know that they're one and the same. So anyway, either way, the calculation is made by having your numerator, which is your average estimated net income, and you divide that into your average investment, which is calculated as your original cost plus salvage value divided by 2. And notice that ROI focuses on annual income instead of cash flows. And so back to our example. $10,000 was that company's net income, and their average investment is the $75,000 outlay plus the $5,000 of estimated salvage value. So you take that, divide that by 2, you come up with $40,000. And for this company, ROI is, or ROAI, however you want to say it, is 25%. So here you want to pick the ROI that's the highest if you have, alternative capital decisions that you might be making. In other words, pick the alternative that has the highest ROI. What are the problems with ROI? Well, income may vary from year to year. Time value of money is ignored. The other thing is it doesn't consider the fact that depreciation is a non-cash item. It's treating depreciation as an outflow. So why would I ever use this method? Again, payback period, ROI, you might want to use if you're a mid-level manager and just purchasing something that's considered a capital expenditure but not extremely expensive, like a building or factory improvements, but maybe like a machine, a new machine versus an old machine. Something easily understood. Now, a more sophisticated and probably the appropriate method to use in major capital expenditures involves discounting future cash flows and comparing the discounted future cash flow over whatever the life of the asset is, or the capital budget is, the capital project is, with the cash outlay spent on the capital expenditure. And so this involves, something called net present value. And so you compare, net present value is a comparison of the present value of cash inflows with the present value of cash outflows. Well, usually the present value of cash outflows is going to be exactly what you spent, because your cash outflow on a capital project is going to be in year one or year zero, really, today. If you, in other words, you're spending money on the capital project today, and in the future you're going to receive a benefit through these cash inflows. And so these cash inflows are really what gets discounted because they are recouped over time. And so what you have to do in determining net present value is choose the discount rate. Usually this is going to be some rate that the company has determined is their minimum required rate of return on capital projects. We're not going to accept any capital projects that are below, pick a number, 10%, 12%, 15%. Once you've determined your minimum required rate of return, you calculate the present value of cash inflows. You calculate the present value of cash outflows in step 3, and then you compare your present value of inflows to outflows, and if the inflows are greater than the outflows, the present value of the inflows are greater than the present value of the outflows, that's a good thing. We'll look at that here in a second. All right, so here we have an example. Star can buy 10 new machines for $75,000 that generates $24,000 cash per year in annual net cash flows. Vindicorp will repurchase the machines at the end of 5 years for $5,000 salvage value. Star's required rate of return is 15%. What is the net present value? Ignore taxes. Well, that's a lot of information. So our outflow, our net present value of outflow is $75,000. So what you're going to do, and I'll explain this better when we get to an example, our example problem, we'll delve into this a little bit more. So I'll just kind of summarily go over this. The answer here is D. Well, how did they get to D? Well, they took the present value of inflows, which is the $24,000 that they're going to receive each year over 5 years. And if you look at page 1121, Exhibit 26-4, up at the top, in the left-hand corner, it says number of periods. And if you go, and then it says discount rate. And so under discount rate, to almost the very right, you'll see 15%. Okay? That is your required rate of return for this company. And if you go down, notice number of periods, 1, 2, 3, 4, 5 down the left-hand column. And if you look under the column 15%, at the 5th period, the 5th year, you see the number 3.3 352, which is what you see on the screen. So you're going to take the annual net cash flows, multiply them by 3,352 to come up with present value of inflows of 80,448. Now you also have to consider here as an inflow the salvage value. But the salvage value is going to be recouped in the future, 5 years from now. And so you have to calculate the present value of those proceeds. And so if you look at Exhibit 26-3, again, looking under the discount rate of 15%, in year 5, when you're going to receive this $5,000, the discount rate is 0.497. And so you're going to multiply the $5,000 you're going to receive in year 5 times 0.497 to come up with $2,485. Well, think about this. What does it mean? What does this discount rate mean? What does the 0.497 indicate to you? Well, it means that $5,000 received 5 years from now is worth 0.497 of what $5,000 received today would be if the discount rate is 15%. And so you're going to, after you do all this, present value of inflows plus the present value of disposal proceeds, which is also an inflow, you're going to add those numbers together to come up with 82,933. And from that, you're going to subtract your net present values of the cash outflows, which is your initial investment of $75,000 in these machines. Net present value is a positive number of 7,933. So, next question is, well, okay, good. I've got this number. What does it mean? Well, what you're going to do is, if you have a project and you have a required rate of return, you're only going to pick those projects which have a positive net present value. In other words, you're getting more present value of inflows than present value of outflows. So, general rule is if the net present value is positive, then the project's acceptable since it promises a return greater than the required rate of return, which is your discount rate. If the net present value is 0, it's still acceptable since you're getting as much of a return as the required rate of return. And if the net present value is negative, the project's not acceptable, and well, because the return net present value of your inflows are less than the required rate of return. Next thing and last thing we'll talk about is replacing assets. Don't want to spend a lot of time on this, but they have an example in the book that you can follow. In this case, they're considering replacing an old bus with a new bus, each with a 5-year life and 0 salvage. So in this case, the cost of the new bus is $65,000. Book value of the old bus is $25,000. Current value of the old bus is $10,000. Loss if the old bus is sold is $15,000. The annual savings of the new bus they've determined is $12,000. How did they come up with that number? Well, they just figure it's more efficient, less maintenance costs, all those things come into play. Better mileage, things like that. Maybe a bigger bus where they can transport more people. The difference in the depreciation between the new bus and the old bus is going to result in an increase in our depreciation, which means less taxes owed. Increase in taxable income, thus, is $4,000, and then they consider taxes to be at a 40% rate for $1,600. So after-tax income is $2,400. So recall, depreciation is not a cash outflow. So just like we did at the very beginning of this chapter, we're going to add back to net income our increased depreciation to get annual net cash flow of $10,400. And so they take their cash outflow, the present value of the cash outflow is, the present value of the cash flow out as of today. And so that present value is the same as the cash outflow, $65,000. And then you're going to have your inflows of while the $10,400, which we looked at here, annual net cash flow is going to be an inflow, and you're going to multiply that by our present value factor. Again, it's a 15% discount rate over 5 years, and just like in our previous example, your present value factor is going to be 3.352. So the present value of cash flow of $10,400 over 5 years at a discount rate of 15% is $34,861. To that, you're going to add what it's going to result in cash inflow wise from the sale of the old bus, $10,000. You're going to add that to your inflows. And then tax savings, $6,000 in year one. So again, if you look at if you look at Exhibit 26-3, under the discount rate of 15%, year one is the factor is 0.87, so that's where they're coming up with that present value factor. So the present value of a $6,000 tax savings at the end of 1 year is $5,220. And so here, the net present value is a negative $14,919. So from what you've learned, would we accept this or not? And the answer is not, because your net present value is a negative number. your inflows from this capital project are going to be less than the required rate of return. Now note, capital budgeting involves many estimates, and some estimates are positive, some are negative. You just have to be as realistic as possible with these estimates, and who knows what's going to happen if it's a 30-year project. Who knows what's going to happen 20, 30 years from now. And so there's a lot of uncertainty of how the future may impact decisions and estimates. Also, conflicts may exist between short-run performance measures and long-run capital budgeting criteria. So there needs to be a follow-up after the project has been approved to see whether or not the expected results are actually realized. How much adjusting you can do, though, is kind of questionable. Once you're in it, it's kind of hard to adjust. Certainly you can't reverse these major capital decisions. The end. We'll do an example, and that'll be it for the term.